A junior ISA can be one of the most powerful ways to invest for your child's future. Here's how to choose the best platform and get started today. Introduced in 2011, they allow you to save for your children in a tax-free account. The annual limit is currently £9,000 per year, which can be made up of a mix of cash and investments. The money can't be touched until the child turns 18, at which point the account is converted into an adult ISA. Being such a long-term investment, I'm going to focus specifically on the Stocks and Shares Junior ISA. The biggest advantages with a junior ISA is tax and time. Any capital gains or any dividend income is completely tax-free. And because of its nature, it's naturally a long-term investment. Time is one of the biggest performance enhancers with investing. And because you can't touch it, it takes all of the emotion out so you can ride out that volatility. Let me show you a few examples of how powerful this compounding can be over a long period of time. First, let's assume you can afford to put just £50 a month into this account. We're going to use an annual rate of 7%. This is based on the long-term average for the global stock market sitting around 10%. In recent times, it has actually been higher, closer to 14%. But I think to be more conservative, it's better to use a longer term average around 10%. We're then taking off another 3% to reflect inflation. So any future value that we get from this calculation is going to have inflation baked in. So if you were able to invest that £50 per month for a course of 18 years and be able to stay consistent throughout that period, you would end up with a future investment value of just over £21,000. That £50 per month is literally the equivalent of 2 beers per week. Now let's say you were able to invest £100 per month over the course of 18 years. There may of course be some lump sums in there from birthdays or Christmas, but let's say the average is that £100 per month. At the end of that 18-year period, the future investment value will be just over £42,000. That's close to a deposit on a house. And finally, let's just take it to the extreme because the max you can put into a junior ISA is £9,000 per year. That works out at £750 per month. If you're able to do that consistently for 18 years, you would have an inflation-adjusted future investment value of just over £318,000. An insane amount of money to give to your child once they turn 18. Now let's have a look at some of the best platforms offering a junior ISA. I picked out 3, the first one being Vanguard. They're one of the biggest players in the investing world and well respected in the industry. You have got a relatively wide range of investment choices, but you are limited to Vanguard's own products. That's their mutual funds and their ETFs. That means you can't use another provider's ETF. And you also can't invest into single stocks. But with Vanguard being such a large platform, they have such a wide range of offerings all around the world in different sectors and different regions, so you can be specific as you want. There's no trading fees, however, there is an annual platform fee at 0.15%. They do say that this is capped at £375 per year, but to be honest, it's a little bit irrelevant because in order for that percentage to come down when you hit the cap, you've got to have over £250,000 worth invested. You've also got to meet the minimum investments. That's £100 per month or £500 as a lump sum. If you want a platform with no annual fee, then Fidelity could be a good option. They offer one of the widest range of investment choices because not only can you invest into mutual funds and ETFs, but you've also got access to single stocks here as well. And if you're not quite ready to choose your own investments, they also have ready-made portfolios too. It's not totally free, however, because there are trading fees. They charge £7.50 for lump sum investments or £1.50 for monthly investments. That may not sound like that much, but say you're investing £100 per month and you're getting £1.50 taken off every time. That's like having a 1.5% charge every time you invest. You've got to earn that before you go into profit. So that would definitely be a drawback with this platform. They have got slightly lower minimum investments compared to Vanguard, so you can invest as little as £25 per month or £100 as a lump sum. But if you want a totally free platform and arguably the best of the lot, then it has to be Hargreaves Lansdown. And that might surprise you because historically, Hargreaves Lansdown have been one of the most expensive providers on the market. Their normal Stocks and Shares ISA has a platform fee of 0.45%. plus trading fees as well. However, with their junior ISA, it's completely free. There's no annual charge and there's no trading fees. There will be some FX fees if you decide to invest into stocks or funds outside of your home currency. But for most people, they're going to have a fee-free investing experience. The minimum investment amounts are the same as Fidelity, so the £25 per month or £100 as a lump sum. And you've also got a similar wide range of investment choices because you can do mutual funds, ETFs, single stocks, and they've also got ready-made portfolios as well. I imagine the idea of them offering a totally free junior ISA is that once the child turns 18, it automatically gets converted into an adult ISA. So their hope would then be, because you've used the platform for such a long period of time, they've got great customer service, you get used to the platform, you then might want to keep the money in normal adult ISA, despite there being potentially other cheaper options on the market. I'll put a comparison with a few other providers on screen now, so you can pause it here if you want to check those out. And you'll also see here a fund management fee. And that depends on what you invest into, because every fund, every ETF is going to have its own fee. And that's baked into the fund itself. So when you're looking at the price and the performance of any fund, it's already had its fee taken off. So although there is a fee for investing into that fund, you don't actually see it directly. And that's not linked to the provider you use for the ISA because it's specific to that fund. In terms of what to invest into, keep it really simple. Remember, you've got a really long time horizon, so you can afford to ride out any volatility. And if you're investing per month, then you're actually going to be reducing your cost basis if the fund does fall in value, for example. And remember, you can't touch any money once it's invested into the ISA until the child turns 18. So make sure you've got yourself covered first before you start investing on behalf of your child. The most straightforward, hands-off and passive approach would be simply selecting a global ETF. That means you're not picking a particular sector or region that is going to outperform. You're simply capturing the world market. A global ETF will also reweight its regions depending on how they perform. One thing you may want to consider as the child gets closer to 18 is de-risking the portfolio. Now that's going to depend on if you think as soon as they turn 18, they're going to want access to the money to spend it. If they're going to carry on investing, then it makes sense just to carry on in exactly the same investing approach you had for, say, the first 15 years. But if you decide that once they turn 18, they need that money straight away, then potentially in 3 to 5 years before they need it, you may want to consider moving some of the money from equities into something like bonds, money markets, or even just cash. I've recently started a free weekly Investing Insights newsletter. To get access, simply click the top link in the description below. It will always be free and you can unsubscribe anytime. Thanks for watching. Hope you found that useful, and I'll catch you in the next one.